Hello, it's Friday afternoon and that can mean only one thing, which is a topical PubSnax twinned with a pint-sized dose of booze logic. So, bubbles. You might think they're quite benign, but actually you could be entirely wrong. Over the last couple of years, the US market has raced ahead of all others and delivered amazing, gravity-defying results. However, if you look at what's been driving that game, it's been principally seven big tech stocks, mainly focused around the development of AI. And their value has been driven up out of all proportion by investors piling money in on the promise of what they might be able to do. And as a result, those 7 stocks are massively overvalued compared to everything else when you actually separate them from the rest of the market. And that's what's known in financial parlance as a bubble. Now, the problem with bubbles is they can be fragile, notoriously so in fact. And we saw that at the beginning of this year when China launched its own AI, subject to sanctions. It's had to develop its own technology and do its own thing. And in January, it launched something propounded to do what all the others could do at a massively reduced cost with considerably reduced computing power required. And this thing was called DeepSeek. What you then had is market flew into a panic. The price of these shares dropped as investors piled out and tried to get their money. However, and about a week later, what you saw is the price of those shares then recovered as the other investors looked a little bit more deeply into it and saw that DeepSeek wasn't really all that it was pretending to be. And if you want to find out for yourself why, go to DeepSeek and input something like, tell me about human rights in China, or tell me what happened in Tiananmen Square. And you'll see that maybe it doesn't have access to the full universe of information. It isn't quite what it's propounding to be. Anyway, that's what happened. That was basically a really good example of a bubble. But what have we learned? Well, the takeaways from this, which obviously we're in the pub on a Friday and afterwards we're going to have a takeaway, is first and foremost, we saw an example of behavioral finance in action, thinking fast and slow. When investors didn't really know what was going on, they reacted emotionally and did something that crystallized a loss for them. They sold their shares off, potentially lost some money. What you then saw is as they began to filter the information, the data that was becoming available about DeepSeek objectively, markets recovered. And those investors who took their time and went through that process didn't go through the process of losing money and all of that pain. The other thing it tells us is bubbles. Keep them in your beer and out of your portfolio. Don't be allured by the potential returns of any particular stock, sector or market. Your best approach to investment is to say avoid bubbles and be well diversified. So a couple of really important lessons about bubbles there, and maybe not quite as benign as you might have thought to begin with. Anyway, on that note, see you next time.